not after tax. Sasa, yes, because I've said that this question has been repeated for 3 times. The first question, I think it was around in 2012. The question was okay. But if you check on this question, it was put as profit before tax. Here it was also put as profit before, sorry, after tax, that is. But it should be profit before what? Before tax. Now, what I want us to do, I want us to start with what is required in Roman 1. Indirect method. And actually, we say over profit or loss for the year which ended such. It's correct to have those 3 subheadings. Always here, we start by determining the cash flow from operating activities. The cash flow from operating activities. In this case, we need to have 2 columns here, and basically our figures are given in thousands of shillings. So that is the first item you need to get, and then from there you leave enough space here because we say this. There are so many items which you record here, and then from there you have the other subheading for determining the cash flow from the investing activities. Remember, under the investing activities, what we consider here, we consider the assets which were acquired, the assets which were sold, in other terms, the assets which were disposed, and also any income generated from investing activities. Then from there you leave some space there, and then finally you have the other subheading for determining the cash flow from the financing activities. And actually we said all the items which we record here, we get them from our balance sheet, specifically at the equity, and also at the non-current liabilities, and also at the non-current liabilities. And then down here, you record the cash and cash equivalent at the start, and also the cash and cash equivalent at the end of the year. The cash and cash equivalent balance brought down. So the cash and cash equivalent balance brought down. This is the cash and cash equivalent at the start of the year. And then we have the cash and cash equivalent at the end of the year. That is balance carried down. Balance carried what? Down. Now, in this particular case, always, I usually advise the student, can you start by recording those two last items, the cash and cash equivalent at the start, and the cash and cash equivalent at the end of the year. In most of the questions, the examiner will have given you this one, cash and cash equivalent at the start and also at the end of the year. If you're not given this one, then we said you basically add like 3 items: the cash in hand, cash at bank, and short-term investment, and then you minus the bank overdraft. Yes, can we go to where we have the current assets in our statement of financial position, and basically see whether we have the cash and cash equivalent. So in our statement of financial position, under the current assets, do we have the cash and cash equivalent? Do we have the cash and cash equivalent? Yes. In our question, we have the cash and cash equivalent. But in some questions, the examiner will not give you that. So maybe under the current asset, you can see you're given the cash, maybe the cash at hand, or maybe the cash in hand. You're given, for example, the cash at bank, and maybe you're also given short-term investment. Short-term investment, this can also be known as financial assets. In case you're given a financial asset at the current asset, that is a short-term what? Investment. And then from there, at the current liabilities, can you check whether you have a bank overdraft? A bank what? Overdraft. So therefore, to compute these cash and cash equivalent at the start, you will take this cash in hand, cash at bank, any short-term investment or a financial asset, you add all these, and then you less this one, because the bank overdraft is money which is owed to the bank. Sasa, this one should be deducted. You add all these, you minus what? The bank overdraft. You do the same at the end of the year. You do the same at the end of what? Of the year. So in case you're not given the cash and cash equivalent, that is basically how you compute the same. But in our question here, we have the cash and cash equivalent at the start and also at the end. Also, from this question, you can see the current ended 2024. Now, in the statement of financial position, we are given the statement of financial position for 2023 and basically 2024. Remember, we said that whatever you have here, these are opening balances, and whatever you have in the statement of financial position for the current year, that is a closing balance. Yes. So here we start by recording the cash and cash equivalent balance brought down. Balance brought down is the opening balance. The opening balance for that, the cash and cash equivalent at the start, is basically 230. And basically the cash and cash equivalent at the end is basically 24.85. 24.85. Those are basically free marks. Those are basically free what? Free marks. So remember what we said is that in all these particular questions in financial accounting, financial reporting, whatever is marked here are entries. Are what? Are entries. Like in our case, we already have 2 correct entries there. Then from there we come back here, and basically we said we start with the profit before tax. That is basically what we start with. Where do we get this profit before tax? This profit before tax, we get it from the income statement, which is above the additional information. Can we go to that statement of profit or loss above the additional information? How much is the profit before tax? The profit before tax, this one is 46.65. 46.60 what? 65. And then we said we make a number of adjustments to this profit. And the first adjustment to this profit, we said we add back the finance cost or the interest expense. The interest expense, which still is from the income statement and in fact above this. Can you go back to our income statement and we take that finance cost? The finance cost in our case is given as how much? The finance cost is given as 1,200. As 1,200. And the reason why we add back this is basically for us to have the PBIT, profit before interest and tax. And then to this profit, we said, or this profit we said should be adjusted with a number of items. Number one, we adjust the profit with the non-cash items. Non-cash items, we said, just recall that acronym, dial G. This D, we said, stand for depreciation on property, plant, and equipment. This I stand for impairment loss on goodwill. Actually, we said mostly at this level, you may not come across this, but once you move to the advanced level, in advanced level, you'll be preparing, you'll also cover this topic, but basically in AFR, you're going to look on how to prepare the group cash flow. The cash flow, which is prepared by a group of companies. So automatically you'll come across that. But at this level, you may not come across that. Then A, this one stands for amortization of intangible assets. We will see whether we have the same. Then this one stands for loss on disposal. Were there some assets which were disposed during the current year, EVS? Were they disposed at a loss? Then G stands for gain on what? On disposal. Gain on what? On disposal. So we said these first 4 items, the depreciation, amortization, impairment loss, and the loss on disposal. This one should be added to that profit. Those items should be added to our profit, whereas this one should be deducted. Should be what? Deducted. So I think on the face of the income statement, we don't have any of those items. So let's go to the additional information. You see what you're given. Let's go to the additional information. In the additional information about your tool, during the year, which ended 31st of October 2024, which is the current year, the directors of the company accepted a revaluation, property revaluation report at a gain of 4.5 million. So basically, what that means that the items of PPE, were basically revalued during the current year. The items of PPE were revalued during the current year. There was a revaluation gain of 4.5. Remember, the revaluation gain is not considered here. Take into account that is a non-cash item. And then you're told the company does not make inter-reserve transfer for the excess depreciation upon what? Revaluation. So does that affect this? No. Number 2, you're told depreciation on non-current taxable asset charged to the profit and loss amounted to 2,780,000. So in our case, we have this depreciation on PPE 27.80, which should be added to that. Number 3, we are told during the year which ended 31st of October 2024, a new patent rights were acquired at a cost of 4 million. Remember, patent rights is an intangible asset. So meaning that one should be considered here, because remember we said what we consider are the investing activities and basically the assets which were acquired, the assets which were disposed. So here we will come and we say there was acquisition of what? Of patent, which are basically intangible assets having a value of 4 million. Remember, this one is a cash outflow. This one is a cash what? Cash outflow. Being a cash outflow, we record it there as a negative. These are basically free marks. which you get in any question for cash flow. And then number 4, we are told the investment held by Betrite Limited are measured at fair value through profit or loss. And we are told neither purchase nor sale of the investment occurred during the current year. Now, this particular point number 4 is referring to which investment? So this note number 4 is referring to investment, which are basically appearing under the non-current asset. Can we go to where we have the non-current asset? Under the non-current asset, basically there are 3 assets. We have property, plant, and equipment. We have intangible asset, and then we have the investment at fair value. So that note number 4 is referring to those particular investments at fair value. And actually, we are told in note 4, maybe you can just go through that point again. We are told investments which are held by Betrite Limited are measured at fair value through profit and loss. We are told there was neither purchase nor sale of the investment which occurred. There was no purchase, there was no sale. But if you check on the value for those investments, you can see the value increased from 55 to 58.25 to 58.25. So how much is the increase? The increase here is 325. Now this increase is actually accounted for in the income statement. I don't know whether you can see that. In the income statement, just above this profit, just before the profit before tax, there is something which is accounted for there, which is known as the fair value gain on investment. Fair value gain on investment. Fair value gain on what? On investment. I don't know whether you can see that value there. Fair value gain on investment. So basically, the reason why given that particular note number 4 is for us to be able to know that that increase in the fair value of the investment was not due to purchase. Sasa, yes. I think that basically what we have on the from the additional information. So in this case, this particular question here, you can see there was no asset which was disposed. We don't have any loss on disposal, or basically any gain because there was no asset which was disposed. And then in this case, I've said we don't have any impairment loss. We may have this because we have intangible assets, but in that case, we have to prepare the intangible asset account. I think first of all, we can ignore that, and maybe we proceed down here and we consider what the changes in working what capital. First of all, I want us to record the obvious items, and we see how many entries can we be able to make even without doing those workings which are complex. So here, under the changes in working capital, we said how many items do we consider here? Who can be able to record that acronym? How many items do we consider here? How many items do we consider here? Yes, we said this acronym is very important here. This acronym is very important here. Yes. So we said R, this one stands for receivables. This one stands for inventory. This one stands for what? For payables. And basically we said this is a formula to guide you. So here we take opening minus closing, and then closing minus opening. Yes. So basically we know receivables and inventory, these are items of current asset. So we go back to our balance sheet, to our statement of financial position under the current asset, and basically you're going to apply this formula. For inventory, that is the first item. You take the opening. Opening is the balance in 2023, which is basically 7040 minus closing, 7040 minus closing, which is 7485. And then that one is inventory. That one is inventory here, which is 7040 minus 7485. So we do the same for receivables, which is 5830 minus what? Minus 6030. And then we go to where we have current liabilities in our balance sheet. Under the current liabilities, we consider payables. Payables, we are taking closing minus opening. So closing is 46, 45 minus what? Minus 3505. Yes. Can we get those the final values? So we said anytime if you happen to come across a question on cash flow, make sure you get those marks there. You get those marks. So let's work out this. For inventory, you have 5830 minus 6030, and basically that one will give us negative 200. What about inventory? We have 7040 minus 7485. 7040 minus 74.85. That one will give us negative 445. I hope that is what you're getting. What about payables? We have 46.45 minus 35.05. And I'm getting 11.40. 11.40. Is that what you're getting? Are those the values you're getting? Are those the values you're getting? If yes, confirm. Those are the values you're getting. Confirm, so that we move to another question. Yes. So those are basically the values. Those are the values. So then from there down here, we said we basically less the tax which was paid, and also we less the interest. The interest is also known as the finance cost, which was paid. I think we can start with this one, the interest or the finance cost which was paid. And actually, we say to compute this, we usually consider two items. The interest or the finance cost from the income statement, this one. And then we go to our statement of financial position, specifically under the current assets. We check whether we have any accrued interest or any interest payable. So in our statement of financial position under the current liabilities, do we have any accrued interest or any interest payable? Under the current liabilities, do we have any accrued interest or interest payable? Any accrued interest or interest payable under the current liabilities? No, we don't have any accrued interest. And therefore, we say the interest or the finance cost which was paid is then equivalent to the amount in the income statement. But we say in case under the current liabilities, you have an accrued interest, we say you should take the accrued interest at the start, which in our case is 0. To this, we add the finance cost in the income statement, which is this one, minus the accrued interest at the end. That should give you the interest or the finance cost which was paid. In our case, that one would be how much? That one would be 1,200. That one will be 1,200. And then from there, we need to compute the tax which was paid. For the tax paid, we say this one, we have to prepare an account. We prepare a tax account, though we say it's not a must. What we do here, for the tax, we said in the balance sheet, in our statement of financial position, we have two components of tax liability. Under the non-current liability, there is something called the deferred tax. And also under the current liabilities, we also have the current what? Tax. You can compute the tax which was paid using the same approach here without necessarily preparing a ledger accounts. But in that case, you must appreciate the fact that we have two components of tax liability. So I think let's avoid this. Let's just use the same approach to compute the tax which was paid here. The tax paid. So first of all, we go to where we have current liabilities. Under the current liabilities in our statement of financial position, we take the current tax at the start. You see this current tax, which is under the current liabilities, this is the tax the company was supposed to pay at the start, which is basically 14.85. And then under the non-current liabilities, we also have deferred tax. So these also are tax to be paid by the company in the future. So we take the deferred tax at the start of the year, which is 19.55. So that is the total tax our company was supposed to pay at the start. We have taken the current tax, I've added the deferred tax at the start. Then to this we add what? To this we add the tax from the income statement. So can we go to the income statement? The income statement, which is additional above the additional information. How much tax was supposed to be paid during the current year from the income statement? The income tax expense for the current year is 13.30. So we add it there. I hope you can see we have taken the current tax at the start, the deferred tax at the start, and then the tax for the current year from the income statement. And then out to this, you minus the taxes not yet paid at the end of the year. So in this case, we will take both the current tax and also the deferred. The current tax not yet paid at the end is 18.80. And the deferred tax not yet paid at the end of the year is 23.70. 23.70. So that will give us the actual amount of tax which was paid. The actual amount of tax which was paid. So we take 14.85 plus 19.55 plus 13.30 minus 18.80 minus 23.70. And in this case, I'm getting the tax which was paid as an amount of how much? The tax which was paid as an amount of 520. 520. Is that what you're getting as the tax paid? as the tax paid. Is that what you're getting? Please confirm. Is that what you're getting? Is that what you're getting? Talk to me. Dagot, is that what you're getting? And Sharon, is that what you're getting? 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 Yes. Okay. So basically that is it. Then from there, we move here at the investing activities. At the investing activities, what do we consider here? We consider the asset which were acquired, the asset which was sold, and any income from investment. I think in this question number 1, do we have any investment income received? Any investment income? This one can also be known as interest received. In this question, we don't have any investment income which was received. Then maybe there are some assets which were, well, there are some assets which were disposed in this question. No, in this question, we don't have any disposal of assets. Any disposal of assets. We don't have any assets which were disposed. But I think in this case, if you prepare the PP account, you should be able to determine the PP which were acquired. But basically, this calls for the preparation of the PP account. So first of all, I want us to record the obvious items without doing a lot of workings. So I think that basically we can only be able to record one item here. Then can we move to financing activities? Can we move to the financing activities? Financing activities. Now, under the financing activities, all the items which we record here, we get them from our balance sheet or statement of financial position under equity and current liabilities. So let's go to where we have equity, items of equity. So the first item of equity we have is what? Is the ordinary share capital. So for the ordinary share capital at the start was 40. At the end of the day, it increased to 50. What causes the share capital to increase is basically issue of shares. So we will say there was issue of shares, which is basically equal to the increase of 10,000. And in terms of how these marked, there's in terms of how this one is marked, some solution combine this with the share premium. Sasa? Yes. So it is always advisable that if you're recording this in your cash flow, can you record it first of all separately and then you get the total? Because you can see the shares which were issued, the par value increased with 10,000. What about the share premium? The share premium also increased. Instead, there was increase in share premium, which equally represents the money which was received, 25. Record that separately here, and then can you get the total? You take it here, 12.5. So because some markers may mark the final figure, so mean that if, for example, you recorded those values separately, you may not get the allocated marks. But record it separately, then get the total, take it to the last column here, the share capital and the share premium. Yes. So that is what we have. Then from there, we have the retained, the revaluation reserve. The revaluation reserve is not considered here. The other item we have there is the retained profit. The retained profit we say that we use this one to compute the dividends which were paid. How do we compute the dividends which were paid? We take the retained profit at the start. That is the formula I gave you. The retained profit at the start, which is 14,755. And then to this, we add the company's profit after tax from the income statement. The profit after tax from the income statement, which is the same with the profit for the year, is 33.35. 33.35. And then to this, we minus the retained earnings or the retained profit at the end, which is 17,505. So that should give us the dividends which were paid. And in this question, the retained profit or the retained earnings account is not affected by anything else. And there is a question which we did for December 2025. There was an excess depreciation which we adjusted in our account. So in this question, we don't have such. So, and I'm getting a figure of 505, not 505, 585. And being the dividends which were paid, this is a cash outflow. And it's also very important to remember that any amount which is a cash outflow, you record it as a negative. If, for example, you record that figure as a positive, as just 585, as a positive rate. That is wrong because these are cash outflow. Cash outflow must be a negative. This is a cash inflow. It has to be a positive. This one is a cash outflow. Once the company acquires an asset, it's a cash outflow. It has to be a negative. That's a yes, it has to be a negative. So that's what we have at the equity. And I think we are done with the equity. So then we go to where we have non-current liabilities. Under the non-current liabilities, what do we have? I think under the non-current liabilities, we are considering one item, that is long-term borrowing. Long-term borrowing is like a loan. At the start, it was 10,300. At the end of the day, it increased to 11,600. What causes a loan to increase? More borrowing. The company borrowed an additional loan. So in this case, we will say there was acquisition of long-term borrowing. There was acquisition of long-term borrowing, which is basically equal to the increase. The increase in this case is 1,300. The increase is 1,300, which automatically is a cash what? Is a cash inflow. So those are basically free and obvious entries we can be able to make in our statement of a cash flow. So have we computed all items? No. How many, for example, entries do we have here? Let's see how many entries we have. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14. So even if, for example, you're to be given 1 mark for every correct entry, you can see that question you already have. You already have 14 marks. And basically, you can see that in this case, you have not done those complex workings. You have not done those complex workings. For example, you have not prepared the PP account. You have not prepared intangible assets account. And basically, that's how you handle these particular questions within an examination setup. Within an examination setup. Because in this case, we said for any question you attempt, you have to finish that question within how many minutes? Within 40 minutes, especially the computation one. 40 minutes, then move to the other question. Sasa? Yes. So there are other items maybe you can compute, like the PPE. We can also compute this one, amortization, but I think no need. So I'm trying to show you how basically you get the free and the obvious what? Maths. So let's do another question. Let's do another question using the same approach. Using the same approach, we do another question using the same approach. Using the same approach. The same approach. Yes, so let's look on this question here from December 2023. December 2023, question 4. December 2023, question 4. And also we do it using the same approach. We do that question using the same approach. We see how many entries can we be able to make. December 2023. December 2023, question number 4. Question number 4, if you are here, you can confirm. Do you have the question with you? December 2023. December 2023, question number 4. You have the question? Do you have the question? Do you have the question? Okay, so what are we told here? The question is the following financial information was extracted from the accounting records of Budo Limited, a public limited company. So we are given the statement of financial position for 2023-2024, non-current current assets, equity, non-current liabilities, current liabilities. We have the statement of comprehensive income, additional information number 1, all the way to note number 3. Then we are required to prepare the statement of cash flows using indirect method and also in accordance with IS 7. So how many marks were allocated here? 20. So I'll say if you happen to come across this question, then you should always start smiling because these are almost like 3 marks. Yes. So we go straight to preparing what is required. The name of the company is basically Budo. Budo Limited. Budo Limited. This is a statement of cash flows. A statement of cash flows, which is basically for the year, which ended 31st of October 2023. 31st of October 2023. 31st of October 2023. In this case, I've said that we need to have three subtitles, or basically, yes, 3 titles here. So always start by determining the cash flow from operating activities. From operating activities, and the values which are given here, they are still in thousands of shillings. They are in thousands of shillings. We need to have 2 columns there, 3 columns there. We have a number of items which we record here. We leave enough space. Then from there, we will determine the cash flow from investing activities. What do we consider here? We consider the asset which were acquired, the asset which was sold, plus any income from investment. Any income from investment. Then from there, we determine the cash flow from the financing activities. So at the financing activities, basically we consider equity and the non-current liabilities. And then down there, we record the cash and cash equivalent. The cash and cash equivalent at the start, and the cash and cash equivalent at the end. That is balance carried down there. Yes, so let's basically move and we record the obvious items. Because I've said in this particular question, we don't have to do those complex workings. So just record the obvious items. The obvious what? Items. So let's start with the cash and cash equivalent at the start and also at the end. Can you tell me, do we have the cash and cash equivalent at the start and also at the end? Vanessa, do we have the cash and cash equivalent at the start and also at the end? Vincent, Priska, do we have that one? Cash and cash equivalent at the start and also at the end? Yes, in this case, we have said you should go back to your balance sheet, specifically the current assets, check whether you have the cash and cash equivalent at the start and also at the end. And it is always advisable you go to where we have current liabilities still in your balance sheet. You check whether there is any bank overdraft. In our case, we don't have any bank overdraft. So meaning that the cash and cash equivalent at the start and also at the end of the year is given. So, and remember the current is 2023. And then we have 2022. So these are opening balances, these are closing balances. So the cash and cash equivalent at the start is 4290. That is at the start 4290, and then the cash and cash equivalent at the end. Is this one is 4670, and then at the end is 63 what? 6360 like that. Then from there, we basically proceed and we record now the profit before tax here. So let's record the profit before tax. Before tax, where do we get this one? We get this from the income statement, which is just above the additional information. The profit before tax is 18,700. And then we make a number of adjustments to this profit. So the first adjustment is to add back the finance cost, or basically to add back the interest expense, of which this interest expense, this one is just above that profit. So how much is the finance cost from the income statement? The finance cost is an amount of 3,800. 3,800. I hope you can see that from the income statement. And basically to this profit, or we also adjust this profit with the non-cash items. We just need to recall that acronym, 𝐉𝐎𝐶. This one stands for depreciation. Depreciation on property, plant, and equipment. This one stands for impairment loss. Impairment loss on goodwill. We say that this level, you may not come across this one. This stands for amortization. Amortization of intangible what? Intangible assets. Then this one stands for loss on disposal. Loss on disposal. And basically this one stands for gain on what? On disposal. The gain on disposal. The gain on disposal. So let's go through the additional information. We see what you're given in the additional information. So in note number 1, we are told the property, plant, and equipment was made up as follows. We are given the costs of the PP at the start and also at the end. We have accumulated depreciation at the start and also at the end. Then we have the carrying amount. Carrying amount is the same with the net book value. And then you're told in the other paragraph of note 1, during the year which ended 31st of October 2023, property was revalued upward with a gain of 1.2. That revaluation gain is not considered here as an non-cash item. The company does not make any transfer for the excess depreciation upon revaluation. However, it accounts for the deferred tax on revaluation gain. This is something we covered in the topic of deferred tax, whereby you say if the company revalue asset upward and there is a revaluation gain, we said we compute something called the deferred tax on revaluation gain. Now, if you can be able to recall, this particular deferred tax on revaluation gain, usually this affects the tax account. When pre-computing the tax which was paid, we will compute the deferred tax on that revaluation gain and basically post it to the tax account. I'll be able to show you how. And then you're told the income tax rate applicable to this company 30%. Depreciation on PP has been charged to the profit. And as you can see, like in this question, we don't have this depreciation. That depreciation is not given. So you have to compute that by preparing the accumulated depreciation account, in which case I think we can just first of all ignore that. Note number 2, we are told, during the year which ended 31st of October 2023, Budo Limited acquired a new patent at a cost of 5 million. There was a patent which was acquired. So that is basically an investing activity. So we will say there was acquisition of basically patent, which is basically an intangible asset at a cost of 5 million, which is a cash outflow. And then you're told any amortization of intangible asset has been included within admin. So there is amortization here. And I think in this question, I'll show you how to compute that, because I think this question was almost similar to the other one which you have done. I'll show you how to compute that. And then you're told the company repaid some borrowing, which had matured. There was a repayment of debt, which is basically a financing activity, and then issued new loan notes amounting to 3 million. So if you're told the company issued new loan notes, or new loans are basically equivalent to debt, or these are basically debt instruments. So these are debt instruments which were issued. If the company issued debt instrument, the company raises money. So anytime the company has issued things like debentures, things like both, and the company has received money, that is a financing activity. So here we can say there was issue of new loans. These are not a bank loan, but I've said these are debt instruments, things like debentures, things like both. So, and once the company issue such debt instrument and the company receive money, that is a cash word inflow. Just record it there as a cash word inflow. I think that what we have the obvious entries. Then from there, equally this question, we don't have any disposal of asset, no gain or loss on disposal. Let's proceed and basically we consider what? The changes in working what? The changes in working capital. Now here we consider equally our 3 items, receivables, inventory, and basically what? Payables. We just need to apply our formula, opening minus closing, and basically closing minus opening. So let's go to where we have the current assets. And the current asset, the first item we have is inventory. So we take opening minus closing. Opening is 5760 minus closing, which is 5880. Receivables, we do the same. We take opening 4290 minus closing 4070. And then for payables, we do the same. Payables, we take closing minus what? Minus opening. So basically, I've said these are 3 marks. These are 3 marks, provided you can be able to record those formulas there. So let's work out this. We start with the receivables. We have 4290. 4290 minus 4070. So this one will give us to 20, which is a positive. Then we have 5760 minus 5880, which is negative 120. Negative 120. And then we have payables. We have 78 minus 82. And that will give us equal negative 400. Negative 400 like that. Sasa? Yes, I think that's what we have. Then down here, we less the tax which was paid. And then we less also the interest or the finance cost. The finance cost which was paid. So let's start with this one. Let's start with the interest or the finance cost which was paid. Remember, in this case, we have said we consider 2 items. The finance cost from the income statement is one. And then we go back to our balance sheet, specifically under the current liabilities. We check whether there is interest payable. Do we have interest payable in our statement of financial position under the current liabilities? Yes. Do we have interest payable? Yes. We have interest payable. We have interest payable. So therefore, because we have interest payable, how do we compute the actual amount of interest which was paid? In this case, I said we take the interest which was payable at the start. The interest payable at the start was 48. And then to this, we add the interest or the finance cost from the income statement, this one, 38. This one should be 48 plus 38. And then we minus the interest payable at the end, which is 35. 35. That is basically how we compute the interest which was actually paid during that year. So the interest which was paid during that year will be 48 plus 38 minus 35. Minus 35. Minus 35. And what are you getting here? I'm getting a figure of 51. I'm getting a figure of 51, yes. So we also need to compute the tax paid. But in this question, I've said, whatever is given in note number 1 will affect the tax account. So therefore, in this question, we must prepare the tax account. Though I've said you can always avoid this, but in this question, we have to prepare the tax account. Now, what do we record in this account? Now, on this side, first of all, we record the deferred tax at the start and the current tax. And the reason why we record the deferred tax, the current tax, as the opening balance of the credit side is because deferred tax and the current tax, these are tax not yet paid. These are items, these are tax liability, taxes to be paid in the future. So any liability, we know all liabilities, they have a credit balances. Then we also do the same at the end. Deferred tax at the end, the current tax. Then what also do we record on this side? On this side, we record the tax from the income statement. Then, as per note number 2, because there was a revaluation gain from the topic of deferred tax, I hope you can be able to recall from the topic of deferred tax, we said anytime the company revalue an item of PPE, and basically there was that give rise to a revaluation gain. That give rise to a revaluation gain. We know as per note number 1, the last paragraph, the company revalued items of PPE, and there was a revaluation gain of how much? 1.2. In other or 1,200. Now, we say in addition to this, we compute something called the deferred tax expense on revaluation gain. This is something we discussed in details in the topic of deferred taxes. If you check the questions we did here. So we said to compute this deferred tax expense on revaluation gain, we take the revaluation gain, which we have here, we multiply that with the tax rate. We multiply that with what? With the tax rate. So the revaluation gain is 1,200. As per note number 1 in the last paragraph, we are told the tax rate applicable to this company is 30%. The tax rate is 30%. So this one will give us an amount of how much? 360. Is that the deferred tax expense on revaluation gain? Yes, 360. 360. Now, how do we account for this? How do we account for this particular amount? How do we account for this particular amount of 360? So we say that this one should be debited in the revaluation reserve account. The revaluation reserve account should be debited in the revaluation reserve account. In the revaluation reserve account, revaluation reserve account, actually this amount should be deducted from this. In fact, if you go to the income statement, can you go to the income statement? In the income statement, which are given above the additional information. So in the income statement down there, where we have the profit for the year, you can see we have other comprehensive incomes. One of the other comprehensive income, or the only other comprehensive income we have there, is the devaluation gain on property, and you are told that is net of the deferred tax. The amount which is recorded here is 840, but basically we know the revaluation gain was 1200. So how is this figure arrived at? This figure is arrived at by taking this one, 1200, minus this one, minus the deferred tax, on minus deferred tax expense on the revaluation gain. And basically that gives us what? 840. That's why we are saying this one should be debited in this account. To debit is to deduct it from this, and then we credit the deferred tax account, or the tax account. Remember, the deferred tax is recorded here. So therefore, this deferred tax expense on the revaluation gain will also be credited, in this account. So we have the deferred tax expense on the revaluation gain, which is an amount of how much? 360. 360. Yes. So then after recording all those items, we will get the balancing figure, which is on this side, and which is the tax paid. Although I've said, if, for example, you feel that SATA working is a little bit complex, just ignore it. Because I've said it's not a must you have to record everything here. Yes. So, but let's work out this. So the deferred tax, this one is under the non-current liabilities in our balance sheet. The deferred tax at the start was 7070. That is the deferred tax at the start. The deferred tax at the end, this one is 6750. 6750. Then at the current liability still in our balance sheet, we have current tax. Current tax at the start was 5570. Current tax at the end is 4230. 4230 is here. Then we go to the income statement. We take the tax for the year from the income statement. The tax expense for the year from the income statement is 4830. 4830. So actually, these are the same items we had in the other question, but in this case, I'm saying we have now this item. This deferred tax expense on the revaluation gain. So what we need to do is to get the balancing figure here, which is the tax which was paid. We add what we have on the credit minus what we have on the debit. So we have 7070 plus 5570 plus 4830 plus 360 minus what we have on the debit. 6750 minus 4230. And basically I'm getting 68. I'm getting 6850. I'm getting 6850. 6850. 6850. 6850. 6850. 6850. Is that what you're getting as the tax paid? The balancing figure in that account? 6850. Is that what you're getting? 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 Yes. So having that, I think we are done here. So let's move and see whether there is anything else we can record there. So in this question, number one, we don't have any asset which was disposed. We don't have any disposal of asset. No asset which was disposed. But there is something I want to show you how to compute. There is something we need to compute here, because I think we have come across the same in the other question. Note number 2. Note number 2, you told during the year, which ended 31st of October 2023, Budo Limited acquired some patent, which you have said is an intangible asset, and we have recorded that there of 5 million. And then you're told any amortization of intangible asset has been included within admin. So I think in this case, we can compute this because equally you have come across this in the other question. Now, for you to compute amortization for intangible asset, what you do, you prepare the intangible assets account. You prepare the intangible assets account. What do you record in this account? In this account, you record the value for intangible assets at the start, which is given in our balance sheet at the non-current assets. You also record the value for intangible assets at the end. So because we have this and we have that, then on this side, you record acquisitions. Acquisitions, the intangible asset which were acquired during the current year, whatever you have there, and also what is given in note 2. And then any balancing figure on this side is amortization. Any balancing figure is what? Is amortization. I think we have this, we have this, we have this. So what we need to compute is that. And that was the same requirement, the same working which was required in the other question. Can we go to where we have non-current assets? We record intangible assets at the start and also at the end. So the intangible assets at the start, which is 2022, is 23,680. This one. And then the intangible asset at the end is 24,290. So we have this. So what is missing is the amortization. Amortization. And you also do the same working in the other question we have done. So 2380 plus 5,000 minus 24,290. So this will give us amortization of 4390. 4390. That is the amortization here. 4390. And basically that one should be added to that profit because it's an uncash what? An uncash item. I think that's what we have. So nothing else we have here. Here we don't have any investment income which was received, or maybe the interest which was received. We don't have any. And then can we move here? We go to where we have equity. We go back to a balance sheet at the equity and also at the non-current liabilities. So at the equity, what do we have? I hope you can see items of equity. At the equity, we have share capital. Share capital increased. So meaning that there are some shares which were issued. So there were issue of shares. So and in this case, I've said, first of all, record that separately, then you get the total. Some markers may mark the share capital and the share premium separately. Some markers will mark the final value. So record that separately, then you get the final value. So for the share premium, you say there was increase in share premium by how much? By 400. So record that separately, but also get the total. So nimesema, there are those markers who will be marking the final value there. Others mark those values separately. Yes. So it's always advisable you record it separately, then get the total. So then from there we have the revaluation surplus. We don't consider that here. And then we have the retained profit. The retained profit, I think in this question we can use that in terms of computing equally the dividends which were paid. The dividends which were paid. So the dividends which were paid, we use the same approach, just like what you have done in the other question. We have said we take the retained profit at the start, 42,400. We add the profit for the year from the income statement. From the income statement, the profit for the year is 13,870. 13,870 minus the retained profit at the end, 52,770. That will give us how much? That will give us dividend paid of how much? 42,400 plus 13,870 minus 52,770. And I'm getting what? I'm getting 35. I'm getting 35. I'm getting 3,500. Is that what you're getting, 3,500? Is that what you're getting? Is that what you're getting? Is that what you're getting? Yes. Yes. So I think that's what we have at the equities. Then finally, at the non-current liabilities, what do we have? We have long-term borrowing. And I think there is some information which are given in relation to that long-term borrowing. I think we were told there were some row notes which were issued. Yes, deferred tax, do we consider that here? No, I think in that case, you can leave that question at that point. How many entries do we have in this particular question here? How many entries do we have? Then there are a number of workings we have not done, but how many entries do we have here? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14. So even if, for example, this is how the question was marked, maybe any 20 at 1, so you can see you already have 14 marks. 14 marks without doing so many workings. So 14 marks without doing so many workings, which are basically good marks. But you may see some instances, the question may be marked like this, any 10 at 2. I don't know how, for example, this question was marked, because you can see the question does not have so many entries here. I don't know whether I can be able to see the marking scheme here. This is a question for December. Let me see, because I want to see how it was marked. But generally, even if, for example, for every correct entry, the marks which were given was 1, so you can see you already have good marks, which are basically 14 marks, and basically the working which we have done here, or basically no marks workings we have done as far as that question there is concerned. Okay, so I think I don't have the marking scheme for that. Yeah, but maybe if I get it, I'll be able to share with you so that you see how the marking is done. But what is important here is basically to know how to earn those particular free marks in any question for cash flow, and the approach to be used in handling this particular question in an examination setup. Because we say that question, you have to do it within 40 minutes, and basically move to the other question. So that is what I want you to understand, how to get those 3 marks, and also the approach to be used in an examination setup such that you're able to finish the question within how many minutes? Within 40 minutes. Within 40 minutes. Yes. So I think that is it. That what is required as far as that question there is concerned. So what you need to do, you don't need even to do any other new question. Just go to the 2 questions we did in class, and you do those questions using this approach, and you see how many entries can you be able to make using that approach. How many entries can you be able to make in your statement of cash flows using that approach, which we have discussed here. Sawa? Yes. Now that is it. That is what was required with that question. Now, today I want us to end a little bit earlier. I don't know whether we take a short break. No need. There is a question which is here, because I think we had agreed with based on cash flow and leases. Cash flow and leases. Now, can we go to the paper for December 2024? December 2024. Yes, December 2024. December 2024. There is a small illustration I want us to do here in relation to the leases. In relation to leases. In relation to leases. In relation to leases. And I hope you have revised that topic of leases. I hope you have revised that topic of leases. So recall in this case, we say that lease is basically a transaction whereby one or an entity can actually give the right to use an asset to another company for a specific period of time, and then the company or the entity given the right to use that asset is expected to pay some periodical payment, which are known as the minimum risk rentals. So the question I want us to do is December of 2024. December 2024, this one is question 4, but we're not doing the entire question. I want us specifically go to note number 3. Note number 3 of that question. Note number 3 is on leases. Note number 3 is on leases. And then maybe I will see whether we are going to do that whole question, because the question is from the topic of published financial statements, and that is an area we need to revise. We need to revise. So if you have this question, you can confirm December of 2024. December of 2024, question number 4. Specifically, I want us to deal with the note number 3. Note number 3 is on leases. Is on leases. Are you there? Are you there? Are you there? Okay, so what are we told here? So automatically we're going to revise on that question. This question we are going to do it because a very good question on published financial statement. But let's first of all go to note number 3. So we are told on 1st of November 2023, 𝐉𝐻𝐈𝐍 Limited entered into a 5-year agreement for an item of parent. This item had an estimated useful life for 5 years. The annual lease rentals payable was payable in advance with effect from 1st November 2023. And that amount was 22 million. So we are told the fair value of the plant was 92 million, and the implicit interest rate was 10%. So this is a transaction for the lease. Now remember what we said is that once a company has leased an asset, if for example you lease an asset, we say that you should recognize 2 items, something called the lease liability, and number 2, something called the right of use asset. So therefore, this company, which is called 𝐉𝐻𝐈𝐍 Limited, is a company which leased the asset. And actually, this asset was leased specifically at the start. Because if you go to the requirement down here, you'll be able to see that you're required to prepare financial statement of this company for the year which ended 31st of October 2024. So the financial of this company ended 31st of October 2024. So when did the financial year started? In this case, we said you need to ask yourself, when will the next financial year start? The next financial year will start 1st of November. So this year started 1st November 2023. So therefore, as per note number 3, you can see that this company entered into a lease agreement at the start of the year here. So we are given the details of that lease. We are given the details of the lease. Now, take into account our company here. The 𝐉𝐻𝐈𝐍 Limited is the one which leases the asset. We say that this company should compute and recognize 2 items in the balance sheet. There is liability, and number 2, the right of use asset. So what I want us to do, I want us basically we deal with that particular note. We use that particular note basically to revise on leases. Yes. So which information or which details are we given regarding these leases? So first of all, you're given the inception date of the lease. The inception date. Remember, the inception date of the lease is basically the date when the lease commenced. That is 1st of November 2023. That is the inception date of the lease. And then you're given the lease term. The lease term, this company leased that particular asset for 5 years. And then we're also given the remaining useful life. The remaining useful life, which is also known as the remaining economic life of the asset, which basically we are told are 5 years. So the lease term, the remaining economic useful life are the same 5 years. And then you're given the annual rentals, which is payable, the annual rentals, which are payable. Remember, we also refer to this as the minimum lease rentals. The minimum lease rentals, which is payable, is 22 million and 22 million. And this one is payable in advance. Payable in advance. Payable in what? In advance. So we say this is very, very important because the minimum lease rentals may be payable in arrears at the end or in advance. So this one is payable in advance. This one is payable in advance. And then also we are given the fair value of the leased asset. The fair value of the leased what? The leased asset, which is basically 92 million. 92 million. And then we have the interest rate implicit in the lease. Implicit in what? In the lease, which is basically 10% per what? Those are the details of the lease. Now, what we say is that once a company has leased an asset, that company should recognize 2 items, the lease liability and the right of use asset. In this case, we said always we start by determining the lease liability. We always start by determining the lease liability. The lease liability. And actually, the lease liability is determined at the inception date of the lease. That is this date here, 1st November 2023. 1st November 2023. Now, how do we compute this lease liability? We say the lease liability, this one is equal to the present value of the minimum lease rentals. Present value of the minimum lease rentals not paid at the inception date. not paid at the inception what date. In other terms, we say to compute the lease liability, what we do, we have to discount. We have to discount the minimum lease rentals which were not paid at the inception date. In the process of computing the lease liability, in this case, we don't take into account the minimum lease rentals which was paid at the inception date. Now, recall, this particular lease, we are told is for 5 years. 5 years. So this is the information we have. Year 1, year 2, 3, 4, and basically 5. So this is the start of year 1, which is always referred to as time 0. The minimum lease rentals in this case is payable in advance. So the first lease rentals was paid at the start of year 1, the other one at the start of year 2, the other one at the start of year 3, the other one at the start of year 4, and the other one at the start of year 5. That is how the minimum lease rentals were paid. So in this case, how do we compute the lease liability? We discount, we get the present value of the minimum lease rentals which were not paid at the inception date. The minimum lease rentals which were not paid at the inception date is that, and that. So in this case, is an amount which was paid at the inception date. So we say that this one does not form part of the liability. This one has already been paid. When discounting, we don't include this. When computing the lease liability, we don't include this. That's why we are talking of minimum lease rentals not paid at the inception date. This, and that are the amount not paid at the inception date. So how do we discount this one? We take, and let's work with all our figures in thousands of shillings. We omit the last 3 zeros. So we take this one, we multiply that with the present value interest factor of annuity at the rate of 10%. At the rate of 10%, then what will be our N here? Because that is what is very important here. What will be our N? Is our N 5? Is our N 4? What will be our N here? What will be our N? Vanessa, what will be our N? You need to ask yourself, how much amount are we discounting? How much amount are we discounting? We are discounting 1, 2, 3, 4. Our N should therefore be 4. If you make a mistake and take 5, then your entire question is wrong. And that's why we say, whenever you're dealing with a minimum lease rentals, you have to be very careful. You have to determine, is it payable in advance? Is it payable in arrears? If, for example, this one was payable in arrears, this amount was payable in arrears. Remember, the first amount was supposed to be paid there. The other one here, the other one here, the other one here, the other one here. So meaning that if this minimum lease rentals was payable in arrears at the end of the year, then our end here should be 5. Because what we discount is this amount which was paid there, that, including the amount which was paid at the end of year 5. Sasa, yes, you have to be very, very careful when it comes to determining your ends. So we work out this. So we have 22 million. So you must recall the formula for this, which is 1 minus 1 plus R, 1 plus R, which is 1 plus 1.1 raised to power negative n. Our n is what? Is 4. And then we divide that with R, which is 0.1. Which is 0.1. We said you must be able to remember that, because we said in a part, the examiner will not give you this particular tables, will not give you the present value interest factor tables. So we have 1.1, 1.1. Let's work out this. Raised to power negative 4. 1 minus answer divided by 0.1 times 22,000. And in this case, I'm getting 69. 737. That is basically the amount I'm getting there. Is that what you're equally getting? Is that what you're getting? Is that what you're getting? We try to hurry because of time. Is that what you're getting? Is that what you are getting? Yes. So having this, then we say that this particular amount has to be amortized. This amount has to be amortized. So in this case, we prepare something called there is amortization schedule. There is amortization schedule. Also, how to prepare this amortization schedule, it always depends with when the minimum lease rentals are payable. In our case, you can see the minimum lease rentals are payable at the start. So the first year recall, this when our lease commenced, the inception date. So the first year ended on 30th of October. So actually should be the the date when the financial of this company was coming to an end, that should be 31st of October 2024. The other year, 31st of October 2025. The other one, 31st of October 2026. 31st of October 2027. 5 years. Year 1, year 2, year 3, year 4, and year 5. So those are 5 years. Yes, 5 years. So the next column here will be for the lease liability at the start. The lease liability at the start. LL for the lease liability at the start. The lease liability at the start. The next column which follows always depend with when the minimum lease rentals are paid. In case the minimum lease rentals are payable at the start, the next column here will be for the minimum lease rentals which was paid. And recall our values here will be in thousands of shillings. The next column here will be for the interest, which is the interest expense. And this one should be computed at the rate of 10%. And the next column here will be for the lease liability at the end. At what? At the end. So I think we can now work out this one. We can work out this. So therefore, those are two things which you should be able to recall how to deal with them. Computation of the lease liability when the minimum lease rentals is payable at the start and also at the end, and equally the preparation of this. Because if, for example, these minimum lease rentals were payable in arrears, equally the arrangement for this one will change. We should have the lease liability, then these columns come here before this one, and then after interest, then we have the minimum lease rentals. Yes. So this liability at the start of year 1 is what you have computed here, 69. 737. And then how much minimum lease rentals was paid at the start of year 1? The minimum lease rentals paid at the start of year 1 is 22 million. But in this case, we say this 22 million is not part of this, lease liability, because you can see in computation of this lease liability, we have used this amount, this, and that. So therefore, in our case, we know at the start of year 1, the minimum lease rentals which was paid is this 22 million. But is it part of this amount? No. So therefore, when preparing your lease amortization schedule, don't include that amount here. These amounts should not be included here because they're not part of this lease liability. So then from there, we compute interest. How do we compute interest? We said we take this one minus this. And then whatever we get, we subject it to 10%. So in our case, we should take this one minus 0. We get 69,737, we get 10%, which is 69. And we will work with all our figures to the nearest whole number, 6974. 6974. Then to get the lease liability at the end, we take this one, A minus B plus what? Plus C. A minus B plus what? Plus C. That's yes. So this minus this plus that. So in our case, what do we have? We have 69,737 plus 6974. So that one will give us 76,711. So that will be the opening balance there. And then at the start of year 2, the minimum lease rentals which was paid is this one, which is 22. We less it from this value here, which is 22. And then the difference, which is 54,711, we subject it to 10%. So which will be 54,711. Then we work out this. So which should be equal to this minus that plus this. So we add 5471, and basically I'll get 60,182. So that will be the opening balance here, 60,182. And then we less the minimum lease rentals paid at the start of year 3, this one. So minus 22. So which will give us 38,182. We get 10%, which will be 38,18. 38,18. So we work out this, which should be equal to this minus this plus this. So plus 38,18. And this card will get 42,000. I'm getting 42. So that will be the opening balance there. Then we less the minimum lease rentals, which was paid at the start of year 4. So we less 22. That will give us 20. 10% of that will give us 2,000. Then we work out this, which is this minus this plus this. So I'm getting 22,000. So that 22,000 would be the opening balance there. And then I less the amount which was paid at the start of year 5, this one, 22. And basically this minus that will give us 0, no interest. And equally, the lease liability at the end of year 5 equally is what? Is 0. So we have amortized our what? We have amortized our what? We have amortized our lease liability. That's huh? Yes. Then after that, after amortizing that lease liability, we then said we proceed and we determine something called the right of use asset. The right of use what? Asset. And equally this right of use asset, we compute this at the inception date of the lease. 1st November 2023. 1st November 2023. So how do we compute these? How do we compute this particular right of use asset at the inception date? In this case, we said we add 3 items. Number 1, we take the lease liability at the inception date. That is 1st November 2023. The lease liability at the inception date is what we have computed here. 69. Remember, these values are in thousands of shillings. 69, 737. And then to this, we said we add any payment which was made at the commencement date of the lease, payment made at the inception date. Payment made at the inception date of the lease. Inception date of the lease. And in this case, we know that at the inception date of the lease, there was an amount which was paid 22 million. 22 million or 22,000. And then to this, we add any initial direct cost. Any initial direct cost. Any initial direct cost associated with that is, in most of the cases, we say that this one would be given as a legal cost. You'll be told that at the inception of the date of the lease, there was a legal cost which was incurred. In this question, we don't have any initial direct cost. So we get the value of the right of use asset. Right of use asset. So we have 69, 737 plus 22,000. And basically, this one will give us 91, 737. So that is the right of use asset. Right of use asset. Then this right of use asset, we said it has to be depreciated. We depreciate this. So we said that this one should be depreciated at the shorter of 2 periods. At the shorter of 2 periods, there is term. In our case, there is term at 5 years. So we take the shorter of these 2 periods, there is term, or the remaining useful or economic life of the asset, which is still 5 years. So in our case, we should take the period which is shorter. So in our case, we have 5 years, 5 years. So basically, we work with 5 years. So therefore, the depreciation per annum for this right of use asset should be equal to 91,737. We basically divide that with 5. We divide that with 5. We divide that with 5. That will give us the depreciation of the right of use asset, 91,737 divided that with 5. And that will give us an amount of how much? That will give us an amount of 18,347. 347, 347, 347, 347, 347. But now, if you check on this particular question here, was the examiner requiring you to demonstrate how to account for this risk? No. So what you need to note, number 1, is, for example, when answering the question here, because the examiner was requiring candidate to prepare statement of profit or loss and statement of financial position. Now, in preparing the statement of profit or loss, that is the income statement, what are you supposed to recognize there as far as this risk is concerned? As far as this risk transaction is concerned, in the income statement, you'll basically recognize how many items? 2 items. The depreciation on right of use asset. This one, which is the amount we have there, 18,347. This one should be recognized as part of the cost of our sales. That's that? Yes, you add that to the cost of sales. Depreciation on the right of use asset. Then we have this interest, these ones, the interest for the current year, for this year, past year, this one. So that one will be recognized in the income statement as part of the finance cost. So the interest on lease liability, this one for the past year, because we are preparing the income statement for this year, 6947, this one should be recognized as part of what? As part of the finance cost. As part of the finance cost. When preparing the income statement, that will be included as part of the finance cost. So those are the two items which were supposed to be included in the income statement. Although you also need to note that when dealing with that note number 3, it was not a must for you to prepare the lease amortization schedule for 5 years. So in such a question, you just need to prepare the lease amortization schedule for how many years? Actually, for 2 years, this year and this year. So reason being, in the first year, you have to compute this one. And then we said when preparing the statement of financial position, this particular lease liability at the end of the year, there is part of it should be recognized as the non-current liabilities. Part of it should be recognized as the current liability. So I want us to do